My name's Tony Archer. I'm a partner here at Ormerord Rutter Chartered Accountants, and I'm going to be talking about some of the tax-related and property-related inquiries that sometimes people overlook when they're acquiring or purchasing property. If you've got a rental property, an investment property, and that's either in your own name or in a limited company, for example, you're allowed to deduct certain costs against it to reduce your profit and reduce the tax liability. So the running cost of the property, that's maintenance and repairs. Generally speaking, all of those are allowable to be deducted and therefore reduce the tax liability. Stamp duty land tax is basically a tax that you typically pay when you purchase a property. So there are rates for both residential properties and non-residential properties, i.e. commercial properties. There used to be more reliefs available for stamp duty land tax, multiple dwellings relief, for example. There are other reliefs that are available. If you buy 6 or more properties together, you can typically claim non-residential stamp duty land tax rates. Capital gains tax, it's when you bought an investment property and you sell it at a later date. The gain, the profit, is the difference between what you paid for it and what you sell it for. There are some deductible costs that you can deduct from that gain in order to reduce the capital gains tax. Capital gains tax is due to be paid within 60 days of completion. Inheritance tax is that depressing tax, unfortunately, that your family has to deal with when you're no longer around. And in the context of property, any property that you have part of your estate, together with any other assets that you have, if that exceeds £325,000, then potentially you're going to have an inheritance tax liability. You would need to consider doing some inheritance tax planning.